Welcome to the weekend edition of TheoTrade. This is Don Kaufman. Here we are on February 27th, 2016. What did we see this past week in the markets, and what are we looking for this next week? First and foremost, let's start with just a quick recap of some of the action last week, because in this weekend edition here, I really want to provide a little bit of perspective on not only, where we're going over here, but more importantly, how to position yourself, for what we currently see in the markets. So let's kick it off here by looking at the S&P futures, because again, we're in a marketplace right now. Individual equities, you may have positions in individual equities, but they still do not matter nearly as much as what the broader market is doing and what the broader market is going to do. Clearly, in this past week of trade, markets are looking for any catalyst possible to trade off of. What that basically means, some news announcement is going to come out, no matter how large or how small the news announcement happens to be. That is inconsequential. All right, and a prime example was this previous week. We actually had an oil report come out and took the markets from what was like utter doom over here, and I'll kind of zoom in. It felt like the bottom was about to drop out of this recent rally. So, 2 weeks ago we have this explosive, the rip your face off kind of rally, as we call it. That rally was all but over, and when you're thinking that's it, we're all going to fall apart, the rally's going to die, oil report comes out. An oil report of all things. Market explodes off of it. But every piece of news, every little nuance, that is how skittish the current marketplace happens to be. Now, again, this last week, did we see a little bit of follow through to the rally? And yeah, the answer is, a minute amount. Markets right now overall, are just at, a key kind of inflection point. So if you stand back from it, and of course everybody wants to know, so Don, are you bullish or are you bearish? At this point in time, I think there could still be a small amount of upside potential left. This rally's got a little bit of legs, but this is the kind of thing that you have to expect in the midst of volatility. Nevertheless, I want to say this without unequivocation, I'm short. I don't care so much about this next week. And when people look at this next week of trade, they're thinking, well, it might rip back up here to, the 1975. Forget about the next week of trade. To me, undoubtedly, the risk ain't worth the reward. And that means if you're long the market right now, and I look at risk reward, and let's just zoom out for a second over here, and let's not worry about, the immediate, let's not worry about the next, week or so. Let's bring up the SPX. I'll come off the futures really quickly. Bring up the SPX, which of course the S&P 500. I think it's one of the most effective ways to look at it. And we're going to zoom out to like a 3-year weekly. And again, in no uncertain terms, the risk ain't worth the reward of being long to me at this point. And that's simply put. What do you think the upside of this market has right now? I think we all have to agree there's a lot of headwinds in the economy. Whether you think the economy is going to tank, whether you think we're going into a recession, it's neither here nor there. Interest rates and central banks around the world, are doing everything they possibly can to inflate the economies out there. Now, again, could that provide some legs to the market? Could we rally a little bit off it? Sure. But I'm telling you right now, all right, you get long this market, you're basically playing chicken with an 800-pound gorilla. It's probably not going to turn out well for you because the upside potential, let's say something gets crazy, we'll just get totally crazy and say the market can explode to the upside. What's an explosion to the upside? What are you going to see? 2150 out of this thing? Right? You can see 2150. Oh, let's get even crazier. Let's say we go all the way to 2200. That's 250 up points in the S&Ps. okay, on a percentage basis. And again, this, you're thinking I'm totally nuts, thinking, 2,200 kind of S&Ps over there. But, I don't think that could happen. But on the flip side, you look at us over here, and again, you kind of zoom out for a second, look at the last 3 years, and it's just the last 3 years over here, it's 1,500. You kind of look at the downside and think like, oh, easily 1,700, if not 1,600, would be quite possible. And I bring up a 3-year, but I don't think that necessarily does this justice, because we're seeing volatility that we haven't seen since 2011 or 2012. Okay, in that respect, I think you have to bring up like a 5-year, just to give yourself, again, perspective. Where we're currently at, where we've come from. And that's when you have to just kind of, gulp and be like, ruh-oh, this is why I don't like the risk reward in the markets. Okay, if you have a position on and you're long duration bullish, you want to play that thing out to the upside. Okay, you're more than welcome to. But the downside of the markets, and if it's going to happen, is going to be too fast and too furious for you to be able to bail out of positions fast enough. Okay, and I state that kind of stuff all the time, but believe me, we could be at 1,700 like much faster than you can sell out of your positions over there. So if you were to look at my overall position, I don't mind showing it. I'm in a beta weighted stance right now. If you're not familiar with beta weighting, that is A-OK. All it basically means is I'm making my position. My position is, right now in oil and S&P futures and NASDAQ and Amazon and Costco and EEM and Facebook and Microsoft and the SPX. I've got some SPX, the Target and Walmart and XLE and XLF. Net. What a beta weighted position means, I'm the equivalent of being short about 2,900 shares of the spiders. All I did is just took the whole position and beta weighted it to the spiders. That basically makes me short, let's just call it 3,000 shares of the spiders. So my position is the equivalency of being like short 3,000 shares of a $195 product. Okay, and that's the kind of risk that I'm taking. And again, that is a little bit more of a duration position. I've got plenty of short duration positions that are bringing in some theta and so forth, but net, I still want to be overall short the marketplace, especially looking at this past week, that the market rallied explosively off of a catalyst like oil. Okay, the market was fishing for anything it could possibly find to actually trade off of. Now, let's go into the near term over there. So, yes, I've got my my stance out there, and my stance out there is, 2016 is going to be a rough year if you just want to hold stocks. Okay, you, in my mind, have to be able to do something more than just do the buy and hold out there, or you're not going to be able to easily weather the storm of the volatility. So with that, in the short duration, sell premium. Okay, it's a good premium selling market. Right now, if you are a premium seller, you already know what I'm talking about. Right now, you're probably going to be selling some out of the money call spreads in some way, shape, or form, just to bring in a little bit of extra theta that's time decay, kind of waiting. Okay, hoping, seeing if markets are actually going to fade a little bit. But what can we expect just this next week? One of the next thing I'll look over at is the calendar. So these are what I would call the catalysts coming this next week. So again, February 29th. Is there a February 29th? There is! Congratulations! We added an extra day every couple of years. This happens to us. Nevertheless, take a look. There's not a huge amount going on necessarily, like Monday, Tuesday. Again, nothing huge, nothing crazy out there. But the reason I'm looking so, intensely into these events is because, again, it was like a lonely little oil report that drove the market. And we exploded off the oil report last Wednesday. Nevertheless, the reason I'm actually looking here at the calendar, there is, again, the first Friday of the month, the employment situation prior to the open on Friday morning. As such, you would think there'd be maybe a little bit of extra volatility kind of packed into this market this week. Okay, and that simply means, like, look at the weeklies. There's 2-day weeklies. By the way, people are asking, like, why is there a 2-day option now in the SPX? Okay, yeah, they threw a midweek option in over there, so it's a new contract. Anyway, the option expiration that really matters to me here, this 4-day expiration, showing about 17 volatility. It only has a $30 expected move. Okay, only a $30 expected move, but again, there's multiple expirations now that you have to be aware of. So there's like midweek expiration, but then there's what? A 6-day expiration. So as you start to look through the different expiration cycles, okay, don't do the double take as many times as I have. There are now going to be in the SPX, okay, multiple week expirations. And the reason they're adding these, okay, expirations within the middle of the week, it's to align them, all right, with the volatility futures. So there's volatility futures out there, and they've got them in like short duration. So there's like a 4-day volatility contract. Okay, so they're trying to align an SPX contract with that. So again, is it confusing? Yes, incredibly confusing. The entire week. Again, the entire week. So through the midweek, now we're getting a reading of about $29. The entire week, we're looking about a $40, all right, move. It's not as much as we've seen as of lately, okay? But if you're selling option premium, you can actually see I've got a position in this expiration here, but if you're selling option premium, I just want you to recognize a lot of the volatility is not likely to come out, and that means that the theta, the decay, is not going to come out until the end of the week. And the reason it's not going to come out until the end of the week, and this is actually displayed here beautifully, because we now have a midweek expiration, it's showing you that there's an extra 2 volatility points being packed into the 6-day expiration. Again, it's by the way, I don't love the idea that they just added another expiration over here, if you didn't catch that too much. But okay, because they did subsequently, it's actually giving us a lot of information, and it kind of tells me as a trader that because there's slightly more volatility packed into the 6-day, it's telling me the employment situation means a lot more, which means these 6-day options, they're not going to decay until probably after the employment situation on Friday morning. So for those of you that do sell weekly premium, you're going to be sitting on the edge of your seat until like Friday mid-morning. You're like, I'm going to be sick. And that, again, you know, it's just kind of a, I guess, a nice consequence of them adding, you know, an extra expiration in there. But it's going to get kind of crazy because you're going to have all these like midweek, and you're like, wait, did I do the 11-day option or the 13-day option? Okay, like they didn't have enough weeklies before. They actually put weeklies on top of their weeklies. Again, this is to align with the volatility contracts themselves. So, yeah, if you were not confused enough with all the weeklies in the SPX, don't you worry. They added more for all of our trading enjoyment. Nevertheless, okay, that's the kind of expected move that we're looking for throughout the course of the week over there. Again, it's not too extreme, about a $40 move, but it is picked up a little bit. One other product I've been keeping an eye on, kind of week in and week out over here, undoubtedly is the XLF, the financials. Now, the reason I point this out, their volatility, okay, is displaying a lot more risk than is the SPX. Okay, and again, the reason I keep pointing this out is if markets, okay, are going to tumble, if markets are really going to feel some pain, the market seems to be pricing that pain into the XLF. And I've continually pointed this out, but again, a 28 volatility doesn't sound like that much, but you start to realize there's a lot of stocks that don't have as much volatility in them as the entire financial sector right now. And again, what makes me a little bit more nervous about this is, number one, the 6-day options have a fairly large amount of volatility versus the 13-day options, meaning they're pricing a lot of risk into the employment situation, knowing that our Fed, the FOMC, is going to be looking at this employment situation number intensely. Okay, so keep that in mind. The other thing is, again, I'm not a huge market technician, but you've seen this kind of, rip and rally inside of the S&Ps. We haven't had any follow through inside of the XLF. The XLF, okay, is right in line with where it was all the way into mid-January. So tried to break out the other day, failed. Okay, this is actually, if you are a market technician, it's a doji star. You know what that means? Indecision candle. What does that mean to me? Absolutely nothing. But what I will note about this, okay, you want to watch the 21 level carefully inside of the XLF. Below 21, it's bearish for the entire S&P over there. We still stay north of 21. You've actually got some room to run. Keep an eye on it. We get up to 22, okay, in the XLF. Again, I'm looking to short anything at those levels out there. 22 in the XLF, I'd look to short it. 21, it's just bearish for the overall SPX. With that, thank you guys very much for joining us here for the weekend edition of TheoTrade. Watch your risk. Again, as I'll state, we've had a nice short duration, okay, big kind of in-your-face rally. This is the kind of thing that's indicative, okay, of real volatility. That's all it is, nothing more. Keep your helmet on, because the next few weeks, these little lulls hit, but these next few weeks, we could see a lot more volatility. Thanks a lot, everybody, again. Bye-bye.